In this video, we're going to talk about interest rates and bond valuation. So we'll start the discussion with trying to understand a little bit about interest rates in general, and then we'll move into some terminology about bonds and debt, and then we'll end the videos with some discussion of how you actually determine the value of an asset. So if you think about interest rates, I think everybody understands the definition of interest, right? It's the cost of using somebody else's money, again, in the form of debt. So the required return, right, is the same kind of return you would think for anything, right? It's the return that's expected if you lend somebody some money. So the idea here then is that the cost of borrowing is exactly equal to the return from investing in borrowed funds. So what determines this return? It's three basic factors. One is inflation, the second is risk, and the third is liquidity preference. And I think we understand the first two a little bit. Inflation is obviously the tendency for prices to rise over time. And risk has to do with the uncertainty of the cash flows and the payment by the issuer of the security. Now, liquidity preference is a little bit different. This talks about our preference to get our money sooner rather than later. And although we'll probably repeat this a little bit later, I think it kind of makes sense. If you want to lend money short term, but somebody wants to borrow long term, they want to do it long term, you want to do it short term, how are they going to get you to lend money long term? Well, the only way they'll be able to convince you to do that is by changing the interest rate. Increasing the payment to you might entice you to lending long term rather than short term. So let's talk about the composition of interest rates, right? The real rate of interest is created by supply and demand, right? So there's supply and demand for everything in the economy. Well, I think by now we certainly understand graphically what happens with supply. Now, what is true, although this talks about funds supplied in the economy, quite frankly, it's more the demand curve that changes than the supply curve necessarily, especially when you think about the securities of a company. So this real rate, again, is just the intersection of the demand curve and the supply curve. And certainly some of the determinants of this interest rate is market oriented, driven by investors and suppliers, but also at the lower end of the maturity scale, a lot of the interest rates are driven by the government, right? So the Federal Reserve sets some basic levels at the low end, if you will, for borrowing. So how do we talk about this composition, or how can we explain it, or I guess illustrate it in the form of a formula, right? So the nominal rate of interest is the actual interest rate that's charged by the supplier of funds. And all interest rates can be decomposed, if you will, into some parts, right? So the nominal rate is R sub 1 here. That equals, this is the real rate we were just talking about, this being created by supply and demand of money. Inflation premium. Now we know that inflation changes with time. So short-term instruments will have less inflation premium than long-term instruments. And then we have the risk premium. So the risk premium is associated with issuer and issue characteristics, right? Things like default risk, liquidity risk, etc. So there are things that have to do with the security and or the company that create this risk premium. So we can modify this a little bit, say the nominal rate of return on any asset is the risk-free asset for that period of time, for that time frame, if you will, plus the risk premium. So the risk-free rate for a 1-year investment will be much different than the risk-free rate for a 30-year instrument, mostly due to the change in inflation expectations. So again, let's kind of forget about this risk premium for a second, and let's continue to talk a little bit about the risk-free rate. There's no place to really calculate this number, right? We don't have a real ready publication where you can go and find something defined as the risk-free rate. So we're going to use the next best thing that we have as a proxy. And the next best thing that we have are treasury bills. And you can find treasury yields anywhere in most published documents with bond information have these yields are published for us. So the only difference, the only thing we really need to consider here is the inflation premium, right? This is driven by investors' expectations, right? The more inflation I expect, the more I want to get paid because I'm worried about losing my value, my purchasing power over time. So if we wanted to try to get a picture of this, if you will, we can refer to something called the term structure. And quite frankly, this is what you see when you find treasury securities published. So if you go to places like finra.org or some of those other publications online, the first thing you will typically see is what's referred to as the term structure. All it is a table that has the maturity values and the only other thing, the maturity dates, and the only other thing we're interested in from that table is the actual yield or the payment to investors for that time frame. Now there is graphical representation of this term structure, and essentially it's going to be a line that represents the horizontal line here represents time, and the vertical line is yields. And what we will find is that the yield curves are different depending on the type of security. So treasury bonds will typically have the lowest yield curve, and as we go up the risk spectrum, we will find that yields go higher and higher. They're going higher because of default risk. So essentially, one of the things we can kind of think of, if these curves are fairly constant, right, what would happen if you could forecast one, then you could forecast the others, right? So the relationship here is very important so that we can add to it. The treasury bond rate, which really is just reflective of risk-free, which is the real rate plus inflation, what we need to understand is that that type of interest, we can predict that with some fair accuracy. So if we can predict this line, that means these lines are also possible that we could predict what they would be. So the relationship between stocks and bonds is that they are opposite of each other. When stocks do well, bonds do poorly, and vice versa. So if they do move opposite of each other, we would want to combine our portfolios so that we could get some diversification. If we have negative correlation between stocks and bonds, then we should be able to get a decent diversification on our portfolio by combining them. So let's continue talking about our yield curves here, right? A normal curve is usually upward sloping. It indicates that we have long-term interest rates are generally higher than short-term. And again, this is driven by some theories that we'll talk about. So a downward sloping curve, you don't normally find that. And a flat yield curve, you can find that from time to time. We want to talk about, in the next several slides, what creates this curve, right? What are the factors that ultimately create this? So the first thing that creates this curve is what's referred to as the expectations theory. Essentially, this just says that the curve reflects what investors think is going to happen in the future. And this expectation, right, since we expect to get higher rates for longer terms, etc., results in this typical upward sloping yield curve. So if we think interest rates are rising, you will see upward sloping. If we think interest rates are falling, we would expect to see a downward sloping curve. And this whole theory is based on a finance theory. It's referred to as the law of one price. And basically it says two investments that are identical have to have the exact same returns. So you can invest in a United States government bond for 2 years, or you can invest in a United States government bond for 1 year, and then for the second year, right? So these are two 1-year investments. You should get the same return from this strategy as you do from this strategy, because this provides us with the exact same investment. So they have to have equal returns. What that allows us to do, since we know what we're paying for a 1-year bond, that also now gives us an opportunity to predict what do we think the return on a 1-year bond will be next year. So we can create a picture, if you will, of what we think 1-year interest rates are going to do moving forward. Another theory that might help us is something called the liquidity preference theory. This, again, we've talked about. It suggests that people in general want short-term investments rather than long-term investments. So to entice people to lend long-term, we have to pay them a higher rate of return. This implies that just because of the liquidity preference theory, we should have an upward sloping curve. So if we think interest rates are going to rise, in general, because of that thought process and the liquidity preference theory, we would expect normally that the yield curve should be increasing. Now, one of the things that can modify all this is what's referred to as market segmentation theory. And this talks about the relative supply and demand for loans at different maturities. So if currently there's a lot more supply at the low end of maturities, right, then since there's a lot more supply, as the supply curve moves to the right, interest rates will fall. So those will typically have very low yields because of the high supply. So again, the three theories in general work, and they say, look, interest rates that we see are created by some fairly logical theories, right? The marketplace itself, through market segmentation, will help create what this curve looks like. The liquidity preference theory gives us some absolute direction in which way we think the curve should go. And then, of course, the expectation theory adds how investors are thinking about the future. So let's think about the risk premiums that we actually see. So the nominal rates on a number of classes of securities are found here, right? So here we have the security of a 5-year Treasury notes, and then we have corporate bonds that have an investment grade and a high yield. And of course, you can see that the difference here, as we get to higher risk, there is definitely higher returns. Now, if you want to actually calculate the risk premium, you take the rate for the corporate bond or the high yield bond, and you subtract from that the 5-year United States Treasury note. So in this case, the risk premium is roughly 1.56% for the investment grade bonds and 5.86% for high yield bonds. The purpose of this risk premium now is to say, okay, what is creating this for the company, right? By their very nature, bonds have risks, right? They have risks in that although the cash flows are fairly certain, there is default risk, there's liquidity risk, there are some marketability issues. So all of those factors go into this risk premium, in addition to the actual financial strength of the corporation. So all of these things are then incorporated in this risk premium. So let's further define some of the parts and characteristics of bonds, if you will. A corporate bond is just a loan, right? That loan pays interest. The coupon, that's the percentage of par that's paid annually. Typically, it's really paid semi-annually, but it's paid as interest. The bond's principal, right, the principal of this loan is called its par value or its face value. Now, typically, this is $1,000. And a bond's maturity, of course, is when the loan comes due. Now, bonds are a little bit different in that the bond only pays interest until maturity. So we'll talk about that as we get to the valuation parts, so you can kind of understand how the cash flow pattern works. But in general, it's an interest-only loan with a lump sum or a balloon payment at the end. Now, what are some other terms? The bond indenture is the contract. It sets out the rules. Some of these rules are what we refer to as standard rules or standard provisions. They're in every single loan you can think of, right? I mean, obviously, you have to pay back the loan. Well, that's in every loan agreement that you can find. But there are restrictive covenants, and these restrictive covenants or provisions are really there to help provide some safety for the borrower, right? So these aren't in every single loan. The less financially sound you are, the more covenants or provisions are in there to help provide some safety for the person that's buying or is lending this money. A sinking fund is just a restrictive provision that requires some systematic retirement of the debt. A security interest is a position that requires some collateral. So we'll actually have bonds that are referred to as senior debt, and the senior debt are those types of debt that have collateral. Now, finally, just like since we have rules, we need to have a referee. And that referee is referred to as a trustee. So the trustee is a paid individual or a corporation, etc. And their job is to make sure that the borrower follows the rules that are set forth in this contract. So who is the borrower? Who are the people that need this money? So in general, you think about it, it's the largest borrower, probably maybe in the world, is the United States government. But there are also lots of corporations that for one reason or another would rather borrow money than use their own money or shareholder money to buy things. The longer the bond's maturity, the higher the interest rate or the cost of the firm. that also, all of these then also transfer to the investor. So if the corporation is paying a higher interest rate, the lender is receiving a higher interest rate. The bigger the size of the offering, the lower will be the cost of the bond, right? Because in general, it's easier to put a whole big issue together than to do it in smaller pieces, if you will. The greater the default risk, the higher the cost. That makes some sense. And finally, just interest in itself. As interest in the economy changes, that will have an impact on the interest rates and the yields that bonds receive. Now, there are two features in bonds that we do need to kind of talk a little bit about, and one is called a conversion feature. A conversion feature allows the investor to change their bond into common stock. So you would want to do this if you thought that after you had the bond, that you thought there was greater opportunity investing in the company's stock than in equity. And of course, there is a calculation of when that would make sense to do. But the idea here is if you're a bond holder, you have fixed income. You can only get what's in the contract. But if there is the potential for more, you may want to convert from being a bond holder to a stockholder. The call feature allows the company, the issuer of the debt, the borrower, to repurchase their bonds at a certain price. They typically do this because of refinancing. And actually the correct corporate term is refunding. So there's a price that's stated in the indenture agreement that's going to tell not only the bond holder but the issuer at what price they can call this debt prior to maturity. Again, all the factors are known ahead of time, so there are no surprises. That's one of the nice things about bonds, and that's why we typically talk about their valuation first, and that is all the cash flows are known. All the rules are certain and are provided for contractually. So that's the end of the first video on bond valuation.